Parag, since you are with us, before I talk to you about your fund, which has done phenomenally well, let me start by understanding your view on the auto space. How do you view this space, and what was your own positioning as far as autos as a space is concerned, which rebound quite a lot from the March lows, and from here on the second effect order, do you see rally in auto to continue, or are you witnessing some opportunity in auto ancillary now?
Yeah, thanks a lot. So basically, I would say that one easy money is made, definitely. We have recovered significantly from the bottom. So here, I would say that there can be some consolidation, some retracement. But as you rightly pointed out, auto component stocks have not moved at all. So there is a good headroom in auto component stocks because, as you rightly said, this quarter was a complete washout. Plants were shut for 45 days and there were so many logistical issues. And many auto component companies had a negative operating leverage. So they reported very bad numbers. So I would say that auto components should be a good investment opportunity from here on.
Parag, please, just hang in there for a few minutes. We need to analyze the numbers and the street reaction with some of our analyst friends also joining in. I'll just come back to you in a moment. Mitul is here with us first. Mitul, how you analyze the numbers this time? Was this the expected kind of a number, or has it? And what would you watch out for in the details?
The numbers are more or less in line with our estimate, or we can say marginally lower. As we know that there was a significant negative operating leverage. However, due to a positivity in the tractor segment with a lower decline, overall performance of the M&M is comparatively much better compared to other peers, those who have reported even EBITDA loss and bottom line a significant loss. Company has reported positive profit. That is more commendable, and we would say it is purely because of the higher contribution from the tractor segment.
Right. Gaurang, Mitul, stay with us. Gaurang, what do you think would the commentary be like? Did they guide for, or did they give an indication that things would be so bad? And also in the details, what would you watch out for? Tractor, I believe, has started doing well already as per management commentary.
Thank you and good afternoon. So first of all, let me say this, that despite a difficult and a challenging environment, I think they have come out with a decent set of numbers. As a disclosure, we do have a positive buy call on M&M from a longish time horizon on the fundamental side. Secondly, I think as we evolve from lockdown to unlock, things are only going to improve, and especially more so for M&M because they contribute their contribution from the semi-urban and rural India. The products that they have is one is this utility vehicle, then you have the tractor segment, and then you have the pickup trucks and light commercial vehicles. So our sense is that these segments are likely to throw in much more better numbers over the next couple of quarters. And along with that, if we have the scrappage policy coming through, I think it is going to be good for heavy and medium-sized commercial vehicle, which of course is one of the products that M&M manufactures. On the sports utility vehicle side, SVUs, I think that might take a little bit longer to evolve, but definitely things look much more stable, given the fact that despite challenging and lockdown situation, M&M has come out with these set of numbers.
Right. Thanks for that, Gaurang. Karunya, what do you see the numbers? Have you looked into the details of it, margins? What were your own expectations, and compared to that, have they fared relatively bravely, as Mitul was saying?
Yes, they have. In fact, the tractors business, the farm equipment segment has really saved the day because M&M, in fact, could be one of the very few names, Ajay, at this point in time to deliver a PAT in the positive territory. Of course, there are a lot of numbers still yet to come, but M&M has done well. In fact, margins have been very good, and a great deal of it is because of not only the cost rationalization strategies that the management has undertaken, but the tractors business. What a rebound it has seen. I mean, yes, a significant part of Q1 was under lockdown, but ever since the market started reopening, It is the rural demand that has shown a very sharp uptick, and it's augured very well for a company like M&M, which has seen historic volumes in the last couple of months as well. Of course, April was a complete lull period. Significant part of May as well, but May onwards and June onwards, they've seen a very solid comeback for tractors, which has augured well for the company. Margins have come in, there's been a beat of 100 basis points on the margins. They have still, despite this difficult environment when everybody is posting an EBITDA loss, they have posted a low double digit, yes, but still a double digit margins growth of 10.3%, a beat on our expectations as well, 9.3%. Revenue was in line, profits, we were expecting it to be slightly higher, close to about 150-200 crores. They've only delivered 70 crores this time around. But I think we mustn't complain given the unprecedented situations that transpired in the quarter gone by. But the outlook from here on, they've not spoken much. Yes, they've said rural recovery is something that they continue to bet on. Sequential improvement is also there. The government package is also something that they've acknowledged and how it has helped farmers, rural workers, etc. But yes, while the announcements are positive, they've said that it would help prevent distress and remains a need for further support still from the government. So they're looking for further aid. As far as the UV and the auto business is concerned, the key brands like Scorpio, for instance, XUV, for instance, not the Scorpio, XUV, which typically do well in the rural markets, they have seen a very solid resurgence as well.
Right. Thank you very much for that, Karunya, as well as Gaurang and Mitul. Let's shift focus and talk to Parag. Parag, thank you very much for being patient and waiting by for us. Let's put the spotlight on your fund then. In fact, both of them, the large cap and the contra fund. And I'll ask my producer to fire the comparative, how you have done in various time frames. In fact, you have managed to generate quite a lot of alpha in your contra fund as well as in your large cap fund. Let me start with the contra fund first, Parag. What worked brilliantly for you ahead of the curve, which at that time perhaps was a little uncomfortable, but right now is helping you stand nicely in the sun?
Yeah, so basically I strongly believe in one thing, that you have to buy good companies during bad times. And that is a philosophy which is very close to our heart at Prudential ICICI PMS. And the other thing is we avoid leverage. We try to buy large, genuine, clean businesses which are gaining market share with a very decent ROE, ROCs. And I would say that we completely avoid leverage. So that has helped. For example, in the month of January, we all know the financials weight was around 42% in the benchmark. And we were completely underweight at that time because economy, even pre-COVID, was not doing that well. And financials are leverage proxy to economy. So we were underweight. We were overweight on pharma, telecom, FMCG names. And so that has helped us to generate this kind of alpha. Now, as we move forward, gradually we feel that as the economy opens up, of course, still there are partial lockdowns happening. But as we genuinely open up the economy, I feel that there's money to be made in cyclicals. For example, now we are reducing our underweight in financials, very select financials, which has a very good deposit franchise, prudent lenders. And of course, they have a very large value sitting in the non-lending businesses like mutual fund or insurance and those kind of names. So I would say that we are now, so that has helped us that we are underweight financials or we are underweight cyclicals going into the event. And then FMCG, pharma, telecom gave us very good alpha. And now we are gradually moving into cyclicals.
Right. Parag, what about large cap? In your large cap space, which are the kind of names or I would say themes you got in early which helped you outperform the benchmark in your large cap scheme?
Yeah, so basically I would say that pharma has helped us a lot across our portfolios, and we as a house had a very constructive view on pharma when valuations were very attractive. Of course, now we have seen a significant rally in pharma. But we were very bullish in the pharma at the very beginning of the cycle. FMCG, of course, has helped us across the portfolios. And so I'm saying FMCG, pharma, telecom, and I would say IT also, because these are the recurring themes. We believe that these themes will exist forever. And so when economy is not going that well, when there is a problem in the economy, we stay away from cyclicals or leverage names. While when there is a clear visibility that economy is gradually improving, then we try to bottom fish in the cyclical names. But that too, we avoid leverage. And that has actually, I would say, kept us in a good stage, because if you have a leverage in the business, if you have a very high fixed cost, then 1 quarter of lockdown or 45 days of lockdown can wipe you out. So I would say that that is why the portfolio companies have survived. And now we are very confident that they will emerge more stronger in this cycle.
What's your approach right now in your contra fund? Have you make any changes, or are you in your strategy? Are you taking a relook? Which area are you nibbling towards, where perhaps people are still not paying attention to, and which are the fully ripened areas which you have started trimming exposure?
Yeah, so as I told you, this 3-4 sectors have delivered fantastic returns. Pharma, FMCG, telecom, IT, those kind of names have delivered fantastic returns. So I would say that, as I told you, we are increasing our weights in financials, very select financials, and that too gradually. We are not saying that we should put our entire money in financials today, but gradually we have to invest, because now financials have corrected significantly, they have underperformed significantly. At the same time, gradual opening up of the economy, RBI policy will help them sail through this. And I'm talking about very, very select financials here. As I said, where the deposit franchises are very strong, where the distribution reach is very good. And lending is also prudent, which is the most important part. And fourth point is, as I said, non-lending subsidiaries have a large contribution to their SOTP values. So that provides cushion to you. The other part is auto components. As we are saying, so the tractors, the two-wheelers, they have started seeing good traction. So the auto component companies who are suppliers to this will start benefiting now, and they have not yet shown that kind of a momentum. Unlike the larger OEM companies, which have actually given very good returns recently, and we were positioned well from that perspective. Also, we had 6-7% weight in auto companies, which were more rural-centric in our portfolios. So that is the stance, that you have to gradually build up cyclical names as the confidence comes back on the economy side.
Valuations in the mid-cap end of the market, there are a variety of indicators which seem to be showing some keenness to look at quality names in the mid-cap. It's not a complete no-go or untouchable space anymore. Be it the business models, especially the ones which are relatively resilient and low debt, as you just said, or be it the ones who have managed to navigate through raised money and showed up their balance sheet, etc. Have you started looking at that space also favorably in any of your schemes? What are your thoughts on valuations there?
Yeah, sure. So basically, whether it is large cap, mid cap, small cap, what we follow is a core 4 framework. And that framework actually tells you that if a management is absolutely clean, and we have seen them through cycles, in the down cycle also, their capital allocation we have seen, and we have a positive view on management and the way they have handled the business over the last so many years. Apart from that, if the balance sheet is very, very under leveraged and there is no debt or very minimal debt, or promoter is clearly committed to reduce debt. For example, just to tell you, in last quarter results, we have seen some of the cement companies have started reducing debt even in a COVID quarter. So that particular thing is very exciting for us, that in a COVID quarter where your plants were shut for 45 days and you are reducing debt, which is a very good sign. And already you were not on a very high leverage levels. Net debt to EBITDA was already below 1.5 and still you are reducing debt. So we look at those kind of qualitative factors before we start investing. Third one is, of course, ROE, ROCs, return ratios, and cash flow conversion. So there should be no significant working capital leakage. Debtor days, inventory days should be properly in order. in line with the industry trend or better than the industry trend. And fourth one, of course, it comes to valuations. And valuations, I believe that in a good company which you always want to buy, the right opportunity comes only when there is a problem in market or sector of that company. And that is the time, and that is how the contra positioning helps. That you can buy it when others are selling, but you can buy the best company of that sector.
Parag, how are the flows right now to your schemes, and what kind of AUM overall have you achieved now and across the PMS business?
So we have around 3,000 crores in our PMS portfolios. And see, we are getting good flows. It's a reasonably good inflows. And so I would say that, yeah, so things are pretty good for us in the sense of inflows.
But what kind of conversations are you having with your HNI clients across the country? Is there, because there is a sense we are getting that a lot of new investors are joining the markets, be it traders or investors. Are you also seeing either one, increased allocations from the existing investors, or two, even inquiries from new investors across the country? Are you also getting that sense?
Yeah, definitely. So it is there's an equity cult which is going on. I hope that, like every time in the past, it does not end in a sorry state. I would say that global liquidity is very, very strong. As we all know, US Fed has expanded balance sheet by $3 trillion in last quarter itself, post-COVID. Bond yields are low. There is I would say there is a complete lack of alternate investment avenues in the world. And that's why everybody is attracted towards either precious metals or equities. You can really see, for example, I was just looking at it and we are chatting through Zoom here. Zoom market cap has touched $75 billion and it hardly has any earnings. So I would say that, yeah, equity cult has caught up and when interest rates are zero, all these things can happen and continue for a while. But my only reckoning is that, one has to be very, very careful, especially in such times of momentum. And one has to control the emotions and not get carried away. So we keep advising to our investors that, we will ensure that we invest in good names. And as I said, companies without any debt or very, very low leverage names, and where we have seen them through last 3-4 decades. So we are not venturing into something which is very, very new and exciting. So that if you remain and if you keep some moderate cash in the portfolio, I think that should be fine. But yeah, right now you are very right. Non-institutional volumes are at all-time highs. So I would say that things are right now in a momentum phase, driven by liquidity and lack of alternative investment avenues. So the other conversation which always happens is when you are seeing lockdowns, when you are seeing economies in such a, I would say, a volatile phase, why stock markets are roaring. So that's a common question we get. And of course, we have to agree it is a liquidity-driven, zero interest rate-driven bull market. But wherever we see a company delivering decent performance, which is outperforming the expectations, a company is making about 20% ROE, ROCs, debt-free companies. I think these companies are getting the attention, and so the P multiples are getting re-rated over there. Of course, there is another basket of the trade where the stocks are very cheap, dividend yields are very, very high. So when you put money in FDs, you get 6% return. In some of the power stocks, you are getting 8, 9, 10% dividend yields. So those are very exciting contra opportunities again. And these dividend yields are sustainable.
Right. Right. All right. Parag, we'll let you go on that one. Thanks very much for watching, for joining us on the show today, Parag, after a very long time. That was Parag Thakkar, Head of Portfolio Management at ICICI Prudential, runs the Contra Fund and the Large Cap Fund, and both the funds have actually generated quite decent alpha, be it 1 year, 3 year, 5 year basis, and even a YTD basis. So they got into some of the names like from the telecom space, some of the pharma names quite early, in the cycle, and that actually benefited while they trimmed names from the financial space before that big cut in the financial space came. With that, completely out of time on this edition of the Newsroom. Thanks very much for watching. Goodbye.